Ladies and gentlemen, we have more massive GME price movement today. Shocker. I know that we're going to go over all the catalysts and how we think this MOASS will play out. First off, we have more insider buying. Larry Cheng, who is one of Ryan Cohen's old friends, bought today. Insiders sell for a lot of reasons, but they only buy for one. Again, we see more volume increasing along with the price. This shows that there is more and more FOMO building, which is just what we want to see. And something that I think is extraordinarily important is the divergence between the stock market and GME. We've been tracking this for a long time, and GME's just been fadoodling around with the market for a long ass time. Today was our first real massively negative beta day where GME was up to call it 15% and the market was down 1 to 2%. That is humongous because this is going to drive the attention of some of these bigger hedge fund guys.
And some of the smaller guys. The thing that got my feelers up was that sweet option degen coming in from Wall Street bets. So the interesting thing about this front is that when you have people start FOMOing in, particularly with options, especially if they're buying relatively close to at the money options, then this forces the option market makers to go in and actually purchase a portion of the shares they might have to deliver. If you ever hear people talk about delta hedging, this is what's going on, because the option guys do not want to be caught in the position where they have to deliver shares to fulfill their obligation from writing the option, but not have the shares. In other words, they're forced to buy shares they don't have on a market when there might not be shares in the quantity that are otherwise demanded, causing the price to skyrocket. The reason that's interesting is that this, I think, has the potential to do what we saw in January of 2021, where let's say you had a Volga-Vana squeeze. So that would be like the initial spark that starts sending up the price. Once the price starts going up, it creates FOMO. So these would be degens, for example, buying in options. But when they start buying into GME with options, the option market makers in turn have to go in and buy a portion of the shares that would otherwise be covered by their options, which just further increases the prices, which just further increases FOMO. And if they're buying options, you get the self-repeating cycle. And I think the make or break point that, or one of the major make or break points between last year and this year, is that if the people who hold contracts that expire in the money, if they demand delivery of GME versus cash settling, and they do so in a way that the average that the market makers are using to manage their gamma risk hasn't been hedged correctly, that would be particularly interesting because that would mean that on, let's say, Monday or Tuesday, the market makers for options would have to buy whatever shares they're short for immediate delivery. And there's no can kicking, there's no exotic bullshit that's going on. No, the shares have to be bought point blank at whatever the cost. And at the same time, if this puts more pressure on the price, guess what happens, Josh? More people keep FOMOing in. And this is just on the upside from options. This doesn't even take into account the people who are short. For example, if the short guys have their positions that become further and further untenable, that might be a problem. And this isn't even addressing, the missing cycle or the can kicking that occurred from, should we say, the missing quarterly cycle that should have been late January, early February.
Yeah, more on that in a second. Today or yesterday, March 22nd, we saw that there was a 20% increase in call buying. This is absolutely massive. If we continue to see this, we'll get the data for today, the 23rd, tomorrow. If we continue to see this humongous FOMO call buying, the exact same thing that Justin just said will happen. So it really comes down to retail and these bigger guys flooding into these buying these calls, hopefully exercising these calls, and that's really what we're going to see, how we will see this MOASS style event. Looking back at the last cycle, Justin, why didn't we see this run up? Because we were making a ton of videos. There were so many FTD ETFs expiring in an OPEX, which usually we would have saw this humongous quarterly run up, but we didn't.
So the answer is, Josh, I have no clue, but I'll take a guess because I think that's what people want. My suspicion is that starting say like late November, December-ish or whatever, right? They ripped apart whatever ETF they could get their hands on to get to GME. So think my Lunchable example is the way to think about that. And what they should have done, arguably, is they should have gone through and they should have started covering, that is repaying back the ETFs, the shares that they borrowed from the ETFs, February. That would have suggested you would have seen that quarterly spike in February, but we didn't see it. In fact, we saw the price go down. Here's my guess. 30,000 foot level. I can't speak to the details. Look at PiFi. That dude knows what he's talking about. I do not, but 30,000 foot, this is my best guess. When February rolled around, if they actually so if someone who was short, let's say, a certain Chicago-based market maker, if they actually failed to go through and return their obligation, you might have had a margin event. Now, I don't want to use the word margin call, but let's just say a margin event that happened where you had the counterparty say, listen, you got to do something. And my guess is part of the something that was done is the people who were short, it's like using a credit card to pay off another credit card. They went to a much more open market. Think like Questrade, think Ortex or whatever, right? Or Fidelity, Vanguard, IBK or whatever, right? Someone who's more of the traditional way of borrowing shares to borrow shares. So you go to IBK or whatever, right? You borrow shares. You take those shares that you get, you turn around and you use that to satisfy the FTDs that you failed to satisfy in February, and now you're on the naughty list. The problem with that one though is that if you're robbing Peter to pay Paul, the first thing is that it's more visible. And because it's more visible, Josh, so what you've seen is from various sources, you've seen not only the cost to borrow increasing, but you've also seen the available shares to lend go down. This suggests to me, at least on the very surface level, that demand is going up from someone. And moreover, if supply is not going up to keep up with it, well, of course the price is going to go up. Or that is the interest rate you have to pay to borrow the shares are going to go up.
Yeah, and the cost to borrow is not just increasing, it is exponentially going parabolic. We saw it around 2, 3, 4%. Now it's up towards 12 as an average. The max cost to borrow was all the way up towards 47% on Questrade, and I guarantee they cannot see what Citadel is using because they have much further deeper pockets than Questrade. And this just shows the counterparty risk. If for one counterparty you're saying, hey dude, ooh, I don't know how I feel about this right now. I'll lend you the shares, but I'm gonna have to lend you them at 40, 50, 60% interest because dude, times are tough. I'm kind of on the hook if you go bust, so I'm jacking them up. And even just the average cost to borrow, 12%. Are you kidding me? If we continue to see these numbers increase during the first squeeze, it was around 30% on Ortex. So this is what we're going to continue to look at, the increased pressure on options. Yesterday we saw 20%. If we can see another 20% increase on calls, then we could very well see this MOASS style event.
Absolutely. My guess is that true MOASS will be a combination of at least these two factors, probably more. The first factor being option market makers having to FOMO in to buy shares
Not
to
not
deliver.
FOMO in, like, they're forced to.
Oh,
Like,
yeah.
if you exercise a call, you are going to get 100 shares. The option maker has to find those shares and deliver them for you. So let's say we see another 2 to 300,000 calls come in. That'd be 30 million shares. That would be a total of like 60 million total shares through call options. Let's say 20% of those, or let's say 20, 30% of those exercise. That's going to be 10 to 20 million shares of GameStop that these option makers then have to go find on a market that is already extraordinarily heavily shorted. So how are they going to do this? It is a very slim, tight market. Imagine there was a $20 million share forced buy and there was no sellers. I mean, that's just where we see a straight line.
Yeah. And the thing is, the shares have to be bought. So one of two things will happen. Either the market makers who sold options correctly managed their delta risk by buying shares up through the run up, so up through before the options expired, which is in the price up, or they somehow screwed it up and they're still short when they have to deliver shares Monday, Tuesday, the following week, and then they have to go into the market and just hit the bid regardless of whatever the price is. But either way, my guess is that it's going to be, let's say, a gamma squeeze from option market makers colliding with short hedge funds or with the shorts being forced to close, and maybe other factors too. But I think those are going to be the two of the big things that are going to collide with each other.
There's a bunch going on right now. I'm sure you guys are excited as ever and probably just beaming with energy throughout the day.
Yeah. You wake up at 3 a.m. in the morning, it's like, shit, why aren't the markets open? It's hard to go back to bed.
Well, guys, we are going to continue to update this the best we can. Thank you for sticking with us, and we will see you on the next one.